Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. Does your portfolio suffer from home bias? Investors' resounding preference for their home markets remains one of the great puzzles of the investment world. Buying locals no doubt has a strong emotional appeal. Supporting one's community can have many positive spin-offs, including the development of local talent and the local economy. As is often the case with investing, though the intuitive response may not always be the best one. Is a strong home bias hurting your investment portfolio? How much home bias do investors have? Home bias, or the preference of investors to allocate heavily to their home financial markets rather than diversify globally, is a phenomenon demonstrated by investors across most markets. A second possibility is information asymmetry. Investing locally comes with the appeal of adding exposure to what I know, while having a sufficient understanding of one's investments is a fair ask. The same Fed study noted that the implicit information cost of missing the benefits of diversifying globally appeared to be very high. Third is an avoidance of taking on excessive currency risk. While this may be less of a challenge in equity markets, where FX volatility tends to be a smaller portion of returns over time, this can pose a bigger share of returns in asset classes such as bonds. Is home bias a problem? An excessive home bias can hurt one's financial health due to unintended concentration and from missing the benefits of diversification. For example, someone working in the energy industry who limits his or her investments to a domestic equity market, which happen to have a large weight in the energy sector, would be doubling up on the concentration risk in one industry. Even a normal cyclical downturn in the industry would pose a risk to such a non-diversified investor, as his or her personal earnings and investment portfolio declines at exactly the same time. Need for international diversification. Research shows that having an excessive home bias, for example, investing primarily in one's home market alone, leads to suboptimal outcome for investment portfolios. One can find many examples over the past few years of how investors would have benefited from a globally diversified portfolio, whether from an industry or currency exposure perspective. The optimal balance between home and foreign assets is likely to vary in each individual situation. However, we believe investors should make a conscious decision to diversify globally as the benefits of international diversification far outweigh the risks. Thank you for watching. See you in the next episode.